it will be recorded and posted to our department webpage, the drought extension webpage, and disseminated through some other social media outlets. So it will be available to view after the presentations today. Yeah, so please, if you have questions throughout the presentation, you can we'll be monitoring chat, or you can just unmute and ask us. But with that, Dr. Fates, I'm gonna let you take over. I'll just kind of be watching things on my end.
Great. Thank you very much. Yeah, as Ryan said, this is the perfect time, especially in light of we've had kind of a change here on the PRF side, and that's kind of what I'll be talking about. Previously, the sign up was November 15th. This next year, though, they've extended the deadline to December 1st. So we thought this would be a great time to get in, at least hit pasture, rangeland, and forage insurance, give kind of an update there, kind of some things that we've been working on and what we've been seeing. And then after I kind of get through this portion, then I'll pass it back over to Ryan, and he'll take it from there. But I did want to mention that at least this portion that deals with pasture, rangeland, and forage insurance, this kind of portion of our presentation is supported by some grant work that me and Dr. Larson have been involved with the Western Extension Risk Management Education Center. So as we think about forage and rangelands and production, obviously we know that probably the biggest input of production when it comes to our rangelands, most important is rainfall itself. We live in a desert. Great state of Utah is a desert, and currently we're really facing a pretty bad situation when it comes to our rainfall levels. This is just the drought monitor, the current drought monitor from November 16th, 2021. If we look at across most of the West, we're in some pretty bad drought, specifically here in Utah. We're categorized, a lot of the state is either D3 or D2, which is extreme. Even some right there in central Utah is D4, exceptional drought. So the situation's not great when it comes to what our current rainfall has been looking like. If we look back a year ago, November 17th of 2020, surprisingly, if you looked at that situation any other time, you would say that's just awful. But compared to this year, we've made some progress. So November 2020, it was even more of the state was categorized as D4, D3, exceptional drought, with the exception being up here in the north in Cache County, Box Elder, Rich, where we weren't in quite as bad a situation in 2020, but still not as a whole, not great for the state or most of the West. So we're kind of entering now we're finishing up our second year now of pretty extreme drought. If we look year over year, you should have been able to compare those images, and the drought monitor, we've done that here in this chart. Looking specifically in Utah, again, you see that for much of Utah, we're actually better off than we were a year ago, or stayed the same. That's that gray color. The exception being that we're actually a little worse off here in the north, as I pointed out. For the country as a whole, we see that where the degradation has happened has been out on the West Coast in California, or up in Montana, and most of our neighbor to the north, Idaho, is also seeing quite a bit of degradation. So what this kind of demonstrates is that year over year, we're going to see some changes, and we expect those to affect our situation in our rangelands and our forage moving forward. But what's surprising is just how much it can be drastic changes. If we jump back just one more year, so now we're into November 19th, so this is 3 years ago, and the situation for the country is completely different. Other than here in our kind of the Southwest states, some in Utah, Colorado, most of the country is looking pretty good in 2019. Aside from a little bit of moderate to abnormal dry D0, D1, most of us could be categorized as having zero drought, okay, especially up here in northern Utah. So what we see is, again, we're not static, and we're going to see quite a bit of variability, when it comes to our precipitation year over year. This graph here, as I jump into looking at our topsoil moisture ratings, I thought this would be an interesting thing to look at and monitor right now, especially as we consider some of the rainfall that we have been receiving as of late that we've been extremely grateful for. In the last few months throughout the state, we've seen some pretty good sizable rains. And as you look at what that translates to into our topsoil moisture, we can see that we've started to see that here in the fall. So what I've got here is the black line, that's moisture ratings that could be categorized as either short or very short. And then our gray line is either adequate or surplus topsoil moisture content. So when you see, we jump back into 2019, where if we compared that, looked at those drought monitor images, we remember 2019, great year. We had pretty good moisture. Most of the state wasn't in too bad a drought situation. We see the majority of our topsoils could have been rated as either adequate or surplus moisture ratings. We even peaked up here almost at 100%, is what it looks like. Whereas then we had 0% that could have been categorized as short or very short. Then as we move into that drought situation in 20, we start seeing the trend change where the gray line dips below the black, and we remain there except for one kind of short month or two in our last winter where we benefited from some winter precipitation. But then again, we had that bad situation where we got, I mean, this year we witnessed this throughout the summer of just absolutely no moisture content left in our rangelands. But we are, so on a slightly more positive note, we are seeing a little bit of a, going into this fall with that, the rains that we've seen, our moisture content in our soils has picked up. And we're now seeing approximately, 75, 80% of our topsoil could be ranked as either adequate or surplus moisture content. So we're grateful for that, and hoping that translates into some better conditions in our pastures and our rangelands. And so as we jump into looking at current conditions, looking at the progress report from the USDA, NASS, they put out they rank and categorize, put a rating out for the pastures in our state, and this is just for Utah. I've color coded this. This is for all our traffic loving people. It's a stoplight system here. So the red is either rated as very poor or poor pastures. Our yellow is fair, everything's okay. And then our green is what we're after, that's our good or excellent rated pastures and rangelands. And for the state, following that same trend of when we looked at the moisture content, again in 2019, when we were having a pretty good year, I mean, we peaked up at almost 90% of our pastures and rangelands at that time could have been rated as good or excellent. And then we start getting into that drought year, 2020, and we start seeing that decline, where about 50% could have been rated as good or excellent, 50% fair. Still overall, not a bad trend and way above the kind of what we would expect on average. But then as we go into our second year of drought, we see that red line climb, unfortunately, up into the 75, 80% range of this summer, where we saw all our pastures pretty much completely depleted, very poor condition, low productivity. 30% could be rated as fair, and then good or excellent, clear down. I mean, we almost were down below 5% for much of the summer months. And again, some uptick. So I don't want to be totally doom and gloom here on the pasture and rangeland side. We have seen, headed into this dormant season, some of these late season rains. And it has passed the eye test a little bit. I commented to Dr. Larson a little while ago about these rains and said, I know it's not much the grand scheme of things in terms of our drought situation, but at least it's passing my eye test. As I've gotten out and driven around the county and around our state, I've noticed that there has been some improvement in our pasture conditions. So we'll continue to hope for that trend. Again, we're going to need some good winter precipitation, good snowpack, if we're going to have a break into a good spring and reverse this trend in our pastures and rangelands and our quality and our production. So what I hope kind of these slides here that I've started out on demonstrate is just how variable our situation can be in terms of our pasture and rangeland, with that the chief input being we need precipitation, we need moisture, and that changes year to year, and that's something that's completely out of producers' control. So when I think about managing our production risk, and I think about good producers, what qualities they have, well, the things that they can control, they try to. Unfortunately, we can't control precipitation. That's out of our hands. So that's where PRF insurance comes into play. This is a product put out by the USDA, and we can't control rainfall, but now we have a means to insure against times of low rainfall. So to be clear, this is not drought insurance, completely different product, but you will hear some confusion. There is some confusion about that amongst our producers. What we're doing here is going to use snow, rain, any form of precipitation as a proxy for forage production. We know that there is a strong correlation between precipitation and production in our forages and rangelands. And so the USDA has come up with a way to measure rainfall on a local level, and then a producer has the ability to insure their acreage under this product and receive an indemnity when there's abnormally low rainfall levels that fall below their selected coverage level. So we'll get into a few of the specifics here. And then what I'd really like to do is, I mentioned we've worked on kind of a grant project, me and Dr. Larson and some other of our collaborators. And we developed a tool that we think is really unique and does a good job of helping producers to walk through this program, understand it at their level, right on their, using their location, looking at their historic rainfall patterns that would have been provided for this product, and helping them make decisions to see if this product is something that would maybe work for them in their risk management plan. So the basics of the program, as I mentioned, we're ensuring local rainfall, local here in quotation marks, because this product uses a rainfall index. Every producer's location, acreage is located within an assigned grid. The grids are approximately 17 by 17 miles. And then the rainfall then is a index of rainfall within that grid. So the data for the rainfall is started in 1948. It's from the NOAA CPC, so that's the National Oceanic and Atmospheric Administration Climate Prediction Center. So they provide the data to the USDA in terms of this is the rainfall that we collected in our weather stations and from this grid. And then the USDA puts this into an index form that we can interpret as those index values, meaning the percent of average. So if there was an index value of 90%, saying that during that time frame that the index was reported, the rainfall was 90% of average rainfall. So we had a shortfall in rain. So the producer's job is to select how much rainfall they want to insure. They might select 90%. If any time the index is reported as falling below that, and they had selected coverage of 90% and for those months, then that's when an indemnity is triggered. Again, I mentioned that sign up date has changed from November 15th to now December 1st. That gives producers a little more time to wrap up their fall season and then make these decisions. But again, the premium is actually not due until the end of the following production year. So I mentioned a little bit about the rainfall provided by NOAA. They use the 4 closest reporting stations to the center of the grid. Each station is counted, but the reporting station is farther, the ones that are farther away get counted less. So it is a weighted system. So this is where some of the frustration comes in. This is a product that is definitely being utilized more by producers. We're seeing a strong increase in the utilization. But as we get out and talk to folks, there is still some frustration, some apprehension as they've talked to some of their neighbors. I've maybe seen some times where they get frustrated because they're measuring their own rainfall, seeing a pretty sizable shortfall in rain, where they feel like, oh, I definitely should have gotten indemnity. But then when the NOAA weather index comes out, when it's reported, turns out, you know, on the average in that 17 by 17 mile grid, they're not seeing that decrease. And so no indemnity might be paid. So that's just one area that can be frustrating. But again, it's just understanding that that generally smooths itself out in the average, that there'll be other times when you don't feel you received a shortfall in rain on your local level, right on your ranch or where your forage is located, but that the grid does register that. So some of those things, well, those inconsistencies will smooth out in the long run. And that's what we refer to as basis risk. And it's just inherent in any product that utilizes an index as a way to trigger indemnities, is that sometimes that index isn't going to match perfectly with what we're seeing on our individual level. And so we need to be aware of that and understand it. But don't just count this product out because of some of these frustrations. I still think it can be useful, and there are definitely some ways that we can go about mitigating that risk. So here's an example on the USDA's website, how you would locate your grid. They have a grid locator tool. I'm going to show you a link to that here in a while. You're able to zoom in right to your area, wherever you're producing, where your acreage is. And then you're able to get this 5-digit grid ID. And that's what we really need if we're going to then start looking at historical returns, what you would have expected, historical indemnities and trends within this product for your location. So you're going to need that grid ID, and you're going to need it also when you meet with your insurance provider, your agent, as you talk about this product. So the decisions that then are in the producer's hand as he does meet with his or her agent are number of acres, and you can insure any amount of acres up to the maximum owned or operated. Then timing of which intervals you want to insure your rainfall in. They can have to be non-overlapping. Each interval is 2 months long. So for example, you'd have January, February, then you'd have a February, March interval also, and a March, April. You can't double dip, meaning you can't insure January, February, and then also insure February and March, since they both contain that February timeframe. But you do have to select coverage in at least 2 intervals, non-overlapping, and you can spread your coverage how you'd like in there. There are some requirements, and it can differ by your region or state, but generally you can't get up to more than 60% of your coverage in any one of those intervals. And then your coverage level that's that trigger point. What amount of rainfall do we want to insure? So that you can insure anywhere from 70 to 90% in 5% increments. So again, if you selected that 90% coverage level, and then the rainfall during that month that you selected fell below the 90% level of average rainfall for that time frame, that's when an indemnity would be triggered. The other thing that I won't spend too much time on here, leave that up to, again, your individual discussions with agents, is the productivity adjustment. Each county is assigned a county base value by the RMA of how much they feel like on average an acreage of forage or grazing should be worth. And if a producer feels like his or her acreage or production should be worth more or less than that, they can make adjustment for that up from 60 to 150% of that base value. So in terms of what is insurable, what type of acreage, well, it's pretty well open across the board. You need to specify whether it's going to be grazing or hay. If it's going to be hay, it needs to be perennial dryland hay. Then also the BLM, Forest Service, those permits public lands as long as you're running and you have permits for it, and that's also insurable rangeland. How many acres should be insured? That's a decision up to the producer. Again, as many or as few as desired. The more you are able to insure, the better you're protected, more coverage you have, but of course that comes at a trade-off of increased premiums. Then as we look at that timing coverage level, that's a little more complicated decision. Again, you must select at least two intervals, two-month intervals. Can't insure an overlapping ones. Can't insure more than 60% of your total acreage in one interval. So here's a good example of those different intervals that we could have. So we could select that March, April, put 60% of our coverage there. We could select that May, June, put the other 40 there. We could break it up into 3 intervals as long as they're not overlapping, and spread and our coverage, make sure it adds up to 100. That's all permissible. As far as the RMA recommendation, their recommendation is select intervals when precipitation is most critical for production. Sound advice, I think, but precipitation is variable. So I demonstrated year to year how that precipitation changes as we looked at our kind of our long-term drought that we're in, but also within a year, we see a lot of variability. So knowing when we're going to expect the most, when we're going to expect rainfall to have the most impact, when rainfall is going to happen on average, when we're going to have shortfalls on average, that's difficult to know and can vary within a year quite dramatically. So this is just for a random grid I selected in Sevier County, looking at that index that the RMA uses as the measure of rainfall for your area. And I have the different years here. Again, you can see the most recent years for this grid. We see that we're well below 100% for all of the months, but all of the intervals, but still quite a bit of variability within the year. 2011 though, where we had great rainfall for this area, still a lot of variability, but it changes the patterns of when we expect high or low. So making that decision of what interval is best for your grid, your area, can be a little bit tricky. And for that, I want to turn to our decision support tool that we created during this grant work. It can be found at farmanalysis.usu.edu. So I'm going to take us through using that same grid that I selected in Sevier County, just kind of an example of how I would approach this situation if I were a producer considering this product for my acreage, to see if it would maybe work out as a risk management tool. So I'm going to reshare my screen here. Ryan, are we seeing the tool?
Yeah, it looks good.
Great. All right, so this is the landing page for our kind of our support decision tools that we've got. We have some other tools here. The one we're going to be interested in today is right on top here, the pasture, rangeland, and forage rainfall insurance tool. So we go ahead and click on that. The RMA has their own tool, and it works quite well. We have a link to it here, the grid locator tool, and you can look at some of their historic returns for an area. The grid tools finder is great. That's why we have a link to it. And the other aspects of their tool work pretty well, but it can be a little clunky, and they don't provide all that much in terms of output and ways to analyze the decision. We've tried to kind of streamline that process, make it a lot more simple. We've just got kind of our Mountain West states here, Colorado, Idaho, Utah, and Wyoming are the only states that our tool is applicable to and works for currently. So again, we select Utah. We're going to be in Sevier County. And then I just selected a grid here of 22574. We'll go with that 90% coverage level, 100% productivity factor. Just give a nice round 1,000 acres of insured acres. Then let's pick our May, June, put 50% in there. Then August, September, 50%. As you start, as either if you were going to walk a producer through this, helping them, or you're a producer yourself wanting to use this tool, I wouldn't worry too much about what you put in initially. Just go ahead and make 2 interval selections, split up your coverage, and then go ahead and hit the submit. And from there, we can start looking at, well, would it have been better to select different intervals, spread my coverage differently? How would it have paid off in at least historically? So as you first submit, all of these tables here are going to be relative to just the last, or at least these top three, sorry, are just going to be what would have happened last year, basically. Okay, so the base value for that grid is $5.06 per acre. We selected 90% coverage, so we're only going to be insuring at $5.04 per acre. So that's total production for the 1,000 acres of $5,040. The subsidy level is going to be 51%. It is heavily subsidized, this product, which makes it a little more affordable for our producers. So this calculates then the total premium you would expect to pay. That's before the subsidy. So then we have that 51% subsidy. This is how much the producer would be responsible for. Here's how much that they would have been indemnified last year based on those intervals that we selected and at the what percent allocation. And so this would have been our return, which would have just been our indemnity less our premium. So this would have been actual positive money coming in, cash flow coming into the producer. Okay, and then we have some historical, just a quick historical summary where you see in blue, this is at return. Okay, the gray then being the indemnity, how much we were indemnity. So the difference there, we have it out right now, but if you click on premium, you can see how much the premium would have been. And so we would have seen for the last 10 years for this grid, we're doing pretty good using PRF insurance in terms of every year we were seeing a positive return for this selection. That's not going to be the case with every grid. By far, it won't be the case, but more often than not, for our state, we are seeing that the positive returns are going to weigh the negatives. Then as we scroll up, so again, this kind of gives us a breakdown for this, just the past year, what we have expected. Here's some idea of historical returns. If we wanted to look at making that decision of which selection should I make, I'd go to that historical data. We've got a number of different graphs and output that you can look through, help you make some better decisions. So these first just have to deal with the rainfall, showing the rain index throughout time for that grid. So again, going through some pretty heavy drought for the last several years with just some pockets of decent rainfall. This messy one here can get a whole lot less messy depending on how many years what years you want to look at. So each one of these you can remove if you want just by clicking on them, simplify it, and compare yearly rainfall patterns for the last 10 years. Then we've got a monthly premium rate, okay, how much you could expect to be paying in terms of premium. Monthly indemnity rate, again, you can select what years you want to look at in terms of what indemnity you could have expected for each different intervals. And this final graph, this is the one that I like to key in on, that I like to focus people's attention on. I think it does a great job of presenting some information in a way that's understandable and more intuitive. So again, we have a 2020, that would have just been last year. Then we have a 5-year average, 10-year average, and a 20-year. We don't want to get into the bad habit of basing next year's decision just on one year's data. So we don't want to look at just last year. We want to look at the more long-term historical data we can look at, the better our decision can be in making that interval selection. So as I look at that purple line, that 20-year line, this is our return, meaning again, our indemnity less our premium. And again, we see for this area, it's all above zero. If your grid came up and sometimes that line was below zero, you would know that on average over those 20 years, if you had selected your coverage for that interval, you could expect that there would be a negative return, meaning you would have paid more premium than you would have received indemnity. But as I look at this, I see that we have a sizable bump here in May, June. If we scale it so that we can actually just look at 2020, rescale that graph, becomes a lot more noticeable that May, June, that seems to be one of the intervals that seems to have for this grid, has a pretty good return. Again, we can't select two overlapping. So if I were planning on selecting that one, couldn't select June, July, couldn't select April, May, both of those not so great anyways. I'd be looking again at August, September, maybe October, November. And so that's what I've done. And as you play with that, you can go ahead and then go back to your policy, select different intervals, and each time you do, it'll update, and then you can compare your, well, here's my 20-year return. What could I expect versus, and again, we saw that drop quite a bit. So if I were back in, put it back in May, June, you can see that over the 20 years, we would have done pretty well selecting that coverage of May, June, 50%, August, September, 50% at the 90% coverage level. Over the 20 years, we would have been earning every year 140% return, basically. So that's what I encourage producers. Also, our agents, if you're using this tool, walking producers through this, locate their grid, go look at the historical returns, see what intervals tend to give for that grid the better returns throughout the last 20 years, help them make an informed selection here when considering the product. So let me return now to my presentation. There we go. So again, there's the website, farmanalysis.usu.edu. If you have questions on that tool, don't hesitate to reach out to either myself or Dr. Larson. He's done a lot of work on that tool, was kind of the creator of it in terms of had the vision behind it. So we will be glad to answer any and all questions about the tool. Now, just to wrap up here on my end on the PRF, there have been this past year, there were some changes considered. They had a time where they allowed public comment on this. They've got all of that feedback back. They didn't have time to implement any of those changes other than, again, they changed that deadline of when sign up is. But these are still being considered. They're not going to take effect next year. And we don't know for sure what are going to change, but just know that there are some of those proposed changes out there in terms of maybe eliminating some of those winter months for coverage selections, going from 2 to 4 month intervals. So it would effectively just wait. You wouldn't have the variability within 4 months would matter a lot more than the 2 months. Factoring in some livestock numbers, I'm not too familiar with how they plan to do that, but that is something they've been considering. Changing some of the weighted county base or weighting some of the county base values, going to smaller grid sizes. In theory, sounds great, but again, we don't know. Sometimes the NOAA weather stations, the availability of those can be difficult if you're going to go to smaller grids in some of our rural areas. And then limit grid selection to physical location of acreage. So these are some of the changes being considered. So just kind of be on the watch for those throughout this coming year as they make announcements of what would then take effect for 2024. So then some key takeaways. Rainfall, very variable. It's our biggest input of production on our pastures, our rangelands. Our PRF insurance is a tool that can be used to help offset some of the financial losses caused by decreased production. It's not going to be perfect. Basis risk can be frustrating. That means that producers are sometimes not going to get indemnified even when they feel like they've experienced a loss in production. But hopefully just as often, there's going to be times where they're indemnified even when there is no loss in production. And some of the research that we've been doing recently has evaluated that the probability that each of these occurrences happen. And what we're seeing is that on average, lots of what we would expect is for those circumstances to cancel each other out, which would leave us with then when either those situations aren't working, that the product is working as intended, meaning when you experience a loss, you'll receive an indemnity. When no loss happens, no indemnity. So we still encourage, despite its flaws, we've seen that it's been a good tool for many of our producers that we've talked to help them manage their risk, their production risk, help offset some of the loss in terms of financial loss when in times of poor rainfall. And again, we encourage you to look at that tool. If you have any questions, please let me know. With that, I'll turn the time back to Ryan.
Thank you, Dr. Fates. Great overview of PRF. So I'm going to start sharing here. Ryan, are you seeing my presentation screen? You're muted.
I'm seeing your
Oh,
teacher's one. Yep, there we go. Perfect.
okay. Awesome. Okay, well, I just wanted to, Dr. Fates talked about managing weather risk. And so as we think about managing risk on a livestock operation, right, weather is a huge piece of that. So I'm going to talk a little bit about the price, managing some of that price risk. And as we think about prices, there's, you know, I'm sure I'm preaching to the choir here, but there's a lot that's going on within the markets right now. So let's look at some of those key factors. One of the key factors that we're watching right now is this reduction in overall cattle inventory. So you can see those 2021 numbers. We're down by 1.3%. You know, you can watch that. We bottomed out in that 2014. We've been rebuilding, peaked out, right? And then all of a sudden 2021, we see that reduction. So we're seeing these herds, the herd size across the United States change. So we're seeing that. And you can see some of this, what we call the cattle cycle, indicated in this graph is this is a percentage change. So this would be positive, or this would be herd growth. Then this would be herd decreasing. So these are negative growth rates, right? So we can see that herd expansion, herd reduction, herd expansion, herd reduction. And so you can see these past 2 years have been 2 years of herd reduction. And this represents that cattle cycle. So the question that we have going forward is, how long do we stay in this herd reduction phase? And there's some things that are impacting that. One of those being drought, right? Especially in the West. Another one is demand, how much, right? If there's demand and some other factors. So these are some of the key things we're watching as we're trying to determine what's going on within the livestock markets. One of the big things that you think about what's driving a lot of this, and this is the retail fresh beef demand index. So something to note here. So 2021, so this is an index, so it's all relative. So 124 was that index number in 2021. As you look at that, right, 2004, 117, extremely strong demand for beef products, right? We can think about a lot of those things as we go to the grocery store right now. I'm sure a lot of us are seeing that impact of that, but this strong demand is really impacting the markets, the livestock markets. Related to this demand is going to be income, right? And so this is being driven by a strong economy. This is being driven by money being put into consumers' hands as they have the funds available to purchase these higher value protein products, right? Instead of buying chicken, they're buying beef. So this is something that we're watching really close. This high demand, which is sensitive to income, right? We can go back and look at, right, why did this drop down here in 08 and 09? Well, that's that's because of the financial crisis, the recession that occurred. Consumers had less money, they were more price sensitive, and they were looking for substitute products versus high value beef. So this is something that we're watching really close. Another factor that we're watching really close are these exports. Something to note here. So this is U.S. and beef veal exports as a sum, all exports. And you can see here, this blue line is 2021. That red line is our 5-year average, dotted line 2020. You can see, first off, we're well above where we have been in the past 5 years. And secondly, that continues to grow. One thing that is impacting that is going to be these U.S. beef exports to China, to mainland China. So I just wanted to point this out. You can see 2015 to 2019, that red line. If you notice, there's not a lot of movement that occurs. It just has not moved. 2020, we started to see some movement, right? Some deviation from that. And that has continued throughout 2021. So this is really driving what we're seeing on total exports. And so this increase in demand is causing us to see these changes in prices domestically. So watching this compounded with increased exports to Mexico. And so a lot of these factors are driving a lot of those prices that we're seeing here in the US. When we look at futures prices, so this is feeder cattle, the January 22 feeder cattle futures price. One thing I want you to notice here, just as Dr. Fates talked about a lot of that variability in weather. So this is just back February of this year. I want you to notice how much that price has fluctuated, right? So we went from 162, right, to 148.50, all the way up to 171, almost back down. Within this calendar year, there has been great fluctuation within these markets. And the producer, the rancher, the farmer, livestock producer is not immune to these movements. These movements are going to directly impact the risk faced by the producer. So managing this price risk. When we look at this from the live cattle side, something to notice here. So this was back April of 2020. We were right at 80 cents. All the way to the most recent, so we're almost at a 140, so almost 60 cents difference, right? In a futures, this one doesn't, right? You don't see quite like you do with the movement that you see within the feeder, but still notice the volatility that exists and that trend that exists. So a lot of market factors are impacting and increasing the risk faced by both processors of beef and producers of beef. So that's hopefully that motivates us to follow and find ways to manage that price risk. When we take some of this more local, so this is coming out of billing, just some regional prices. So this is 500 to 600 pound steers, right? You can see that blue line 2021 really following that 5-year average. One positive note is we are above 2020. When we look at those prices, but we are falling really close to that 5-year average. So when we talk about tools to manage price risk, there are futures and options. Working with a broker, whatnot, you can use futures and options to manage risk. On the insurance side, we do have some insurance products that function very similar to an option type product. LRP, livestock revenue protection or insurance. Then this livestock gross margin insurance. And those are the two I'm going to focus on today, just real briefly here to talk about. So livestock risk protection is available for hogs, fed cattle, feeder cattle, and lambs. And so really think about livestock risk protection, revenue protection as a floor. You put that floor down and prices cannot go below that floor. With that, there's 70 to 100% guarantees. And this is all based on CME futures prices. So that's kind of the mechanism within it. So like I said, it's protecting the producer from these unexpected price declines. With that floor, right? The nice thing about this is it puts a floor down, but does not put a ceiling. Or in other words, it protects you from those declines, but still gives you the benefit of those upswings in prices. So you can capitalize on those. So with that, take that into consideration as you're thinking about purchasing or utilizing this type of product. Futures markets are the driving factor. So, right, we look at futures markets and theoretically we expect those, right, to encompass all the behaviors and thoughts of those participating in those markets. So we utilize those as our expected prices. So LRP takes into account what we call those expected price changes when we look at those. LRP, right? So it's available for feeder calves, steers, heifers, Brahman, or dairy. And there's some different weight categories, less than 600 pounds or 600 to 900 pound target weight. On the fed cattle side, we can look at those weighing in between 1,000 to 1,400 pounds. When we look at some of the other things, so, right, like I'd mentioned earlier, approximately we can have coverage prices from 70 to 100% of those CME futures prices. And one of the key decisions a producer has to make is this, the length of that policy. We go all the way from 13 weeks to 52-week policy coverage lengths. So keep that in mind. There's tremendous amount of flexibility in the lengths of those insurance policies. We can go 1 to 3,000 head per that specific coverage endorsement, or 6,000 per year on that July 1st to June 30th calendar year. So keep that in mind as you're thinking about that. Let's keep here. One of the major changes that has occurred recently, just in the past few years, is a lot of complaints, a lot of discussion went about why are ranchers and livestock producers not utilizing LRP, and so they said, well, let's make it a little more affordable. So there is a subsidy involved with LRP, and you can see, so the old subsidy, right, was 20, 25, 30, 35%. And so the new subsidy, right, starts at 25 and goes to that 35% quicker. So if that 80, 90% used to be a 30% subsidy, now is a 35. The 90 to 95% used to be 25%, now it's 30. So you can see that subsidy should make this product a little more affordable for the producer. So the question is how do I buy a LRP? So you do have to work with a certified agent, and that agent can help you establish that eligibility if you are eligible to purchase it. One of the things about this product is it changes daily. So every day there's a set of prices that come out, right? You can follow those through this website here, right? You can get that same report. And so keep that in mind. Sometimes because of insufficient market data, you may not be able to go out 52 weeks or whatnot, just because there's no data out there. So it's not a guarantee that you can always get some of those coverage periods. And then when you are ready to purchase, you have to file that specific coverage endorsement, and that you must own that livestock when filing that specific coverage endorsement. That specific coverage endorsement is just simply the coverage price, your price floor, ending period, the number of animals, the target weight, and the premium due. So in addition to that subsidy. So that's your specific coverage endorsement. As I said earlier, there's a report that comes out daily, and this is what that report looks like, right? It has your commodity, your state, right? Your different types, steers, weight, Brahman, whatever that is, your coverage endorsement, coverage price, coverage level, and all that you can take into account into this, that price sheet that's reported daily. So let's just quickly work through an example here. So this is using this year's data. So this is, I purchased this in June. I exercised it in November. So I have 100 head. I'm figuring they're going to be 700 pounds. So my coverage price, if I were to purchase this in June, was 145. I assumed that I own 100%. So my total insured value was that 101,500. The rate on that, based on that LRP sheet that I showed you, was just at that 0.02087. So my premium, which is based on that insured value, would be that $2,118.31. But at that rate, I was at a 35% subsidy, so my subsidy would be $741. So my total premium would be $1,376.90. Now, so if I want to think on a per head basis, roughly $14 a head is what it would cost me to buy this insurance. Now, when we go through this, right? So my coverage price was 145. My actual ending value, right, is that 155.76. So you can see that ending value is above that coverage price. Now, for an indemnity to be triggered in this insurance product, we need that we don't need it, but that ending value has to be below that coverage price. So in this case, that coverage price minus actual ending value was 1076, which is below it. So there's no indemnity triggered in this case. So you would have to pay that full premium. Now, yeah, there we go. So you can see, right, we'd end up paying that $1,376.90. Now this is 2021, but right, you had to pay that premium, but you also had the market improve. So more than offsets that cost. So it's not always a bad thing that you have to pay that premium, right? When we look back to 2020, right, our coverage price is 128. Actual ending value went down over that period, right? So our total indemnity was at 74.83. right? So our premium was at 32. So we, the difference there after paying that premium was 4,244. So 2020 was a exact opposite of what we saw in 2021. Now, when we look at this historically, so you can see that in gray there in that blue line, that's our expected ending value, and that's our in red is our actual ending value. So you can see, right, how that fluctuates over time. A little easier way to look at this is the net effect per head over time. So starting in 2007, you can see the insurance LRP paid out. 2008 paid out almost $90, $22. Right, and then we had a period from 2010 to 2014 where it did not pay out. 2015, 2016, right? So you can see, as an insurance product, it's insuring during those times when prices decline. So of course, it's not going to pay out every year. When we look at this on a whole, it's over this from 2007 to 2020, roughly a $26 net effect per head. So a positive net effect per head as you're thinking about this. So as a producer, I would seriously consider and analyze this type of product to protect yourself against those price declines. Pencil that out, whether that premium per head is really going to negatively affect the financial status of your operation. But this product is something that seriously needs to be considered. So just quickly, I also want to talk livestock gross margin. This one's based on kind of insures against the cost of feed versus the price received for the cattle. So this one is right. You guarantee, you insure a margin. So market value livestock minus feeder cattle and feed costs on cattle. So this is intended for not your typical cow calf producer. So it's going to be a little different there. So any producer who owns cattle in the states of Colorado, Illinois, Utah is included in that. So you can see it's not all states are included in this insurance package. And so one of the key provisions is that only cattle sold for commercial or private slaughter primarily intended for human consumption. So that's a key distinction there, is that those cattle have to be headed for slaughter. So keep that in mind as you're thinking about this product. So the key features of this product, we have our gross margin guarantee, and that's calculated right. You take a deductible. So this insurance product has a instead of a coverage level, has a deductible, and based on that deductible is kind of how they use it as a proxy for the insurance coverage level. And so you simply take that deductible times the total number of cattle to be marketed from the expected total gross margin. Our expected total gross margin, what they've done, what the risk management agency has done is develop these formulas, right? So for a yearling finishing operation, it's $12.50 times the price of live cattle at that time. And then it's 5 months prior, we take the price of feeder cattle, and 2 months prior, we take the price of corn. So we're just calculating these margins based on, and then the calf finishing is just a tiny bit different, looking at those equations. So just a little bit different, but that's simply just used to calculate that expected total gross margin. And then once we've calculated that expected, then at the end, we calculate an actual, which is just simply those live cattle at that time, feeder cattle at that time, right, minus 5 months. So just at the end of that 11th month or that 12-month period, then we take the price of corn as well. The actual prices, you can see there, we have to use the average of those daily settlement prices. So we're using those future contracts again. In feeder cattle, we're using an average of those settlement prices as well with those futures market contracts. So LGM is a little more complicated, in my opinion, when you start looking at it, but it still has the potential to be a great, if you're in that type of market, a great product to manage that, especially right on a year like this when we've seen those corn prices jump up so high. It's a great time to think about it. So indemnities are triggered right when when you look at that difference between the gross margin guarantee and the actual total gross margin. So like I said, that deductible, so it goes from $0 to $150 deductible. And just like with LRP, there's different subsidies. If you do a $150 deductible, there's a 50% subsidy on that premium. So you can see it makes a huge difference. So all I've done here is over a 10-year time period, If I'd purchased that insurance with a $0 deductible all the way to a $150 deductible, you can see some of those net returns and the profitability. Percent return is just simply my proxy for profitability, or how well does that insurance product work. You can see that there's kind of a sweet spot there with that $70 deductible where you max out that subsidy at that $70 mark. It gets that highest return, kind of the most risk management, most bang for your buck from a producer perspective. When we look at this over time, 2007 to 2019, you can see that livestock gross margin paid out 2008, 2009, when those markets really were struggling, 2012, 2016, and 2019. So overall, we had a positive net return, but you can see those years. It doesn't pay out every year, right? But when it does pay out, it provides a great amount of risk protection for producers. Just one more chart here. As you look at this, you can see, right? So you can see that this is net returns in light blue, percent return in dark blue, and producer premium, right? Once again, we're going to that $70 mark, right? That's kind of what I call that sweet spot again, of those producer premiums are at their lowest, net returns are at their highest, and our percent return. So kind of a sweet spot of looking at maximizing the returns, maximizing the benefit to the producer. So, right, if I were to give you one key takeaway, right, these are great risk management tools. Dr. Fates and I can't emphasize enough the amount of weather volatility, amount of price volatility on both the input side, output side. It's a great time to be utilizing these tools, PRF, LRP, LGM, to manage a lot of that volatility that's inherent within a lot of these products. As with any presentation, we'd appreciate your willingness to just provide some quick feedback. Here's some evaluation. You can either just use the QR code or here's the website, the chat. It is put right here in the chat as well. You can access that website from the chat. We'd appreciate any evaluation or feedback that you could give us. So with that, I'm going to stop sharing. And happy to answer any questions.
Emphasize that it is a very short evaluation, so it shouldn't take very long, and we really appreciate any feedback you got. So yeah. Thank you.
Oh, thanks, Ryan. We're right at 2:58. We're right about at our time. So if there are any questions, please, if you don't want to ask them now, Dr. Fates and I are always happy to answer emails, phone calls. Please reach out to us at any time. Okay, well, thank you all for participating, and enjoy the rest of your day.